So, Professor Goodhart, over the last few weeks, we have seen some very interesting developments in the markets. We've seen a rapid deterioration in the capital and liquid assets of many banks. And we've also seen that banks making efforts to recapitalize in the markets, raising capital can be a death sentence, as was the case with the SVB. The solution that we've arrived at seems to be that some sort of government-supported mergers and acquisitions seem a tool for recapitalizing banks. Do you expect that more banks will need to be recapitalized? And do you see any other policy tools or instruments besides government-sponsored mergers and acquisitions as a way of recapitalizing banks in this volatile time?
I think there's a potential difficulty in that the mergers will lead to a greater extent of market power and oligopoly in banking. The extreme example now is, of course, UBS, which is the sole huge bank in Switzerland. And UBS has almost become a sort of a single state bank. And in the US, the really big systemically important banks have done perfectly well. It's the mid-sized banks that are in trouble. And there's a question about the desirable structure of our banking system. And do we really want to go down the road having a world in which there are only a very few absolutely huge banks, which by their size are totally systemic and cannot be allowed to fail? If we don't go down that road, what can be done about the fact that on a mark-to-market basis, the effect of raising interest rates has led to losses on their holdings of longer-term assets, both governments and longer-term mortgages? And I think one answer to that is going to be that banks actually will now raise the spread between their deposit rate and their lending rate as a protective measure. And they will be able to do that. And so that bank profitability now will probably go up. It's possible that the situation in the US, which is unlike that in Europe, is such that some of the medium-sized banks will need a kind of TARP exercise, which we had in, as you will remember, in 2009 with Geithner, whereby the middle-sized banks, whose solvency and valuation on a mark-to-market basis is in trouble, will have to raise equity. If they cannot raise it easily in the market, they will get it in effect from the government, and the government will require a fairly large return and will sell out as soon as possible. I don't know whether the situation is such that there will need to be a TARP exercise, a troubled asset recovery program, over this coming year. It's I think, a possibility. I think it's a question of really trying to assess by the supervisors exactly how much weakened these middle-sized banks have now become as a result of the increase in interest rates impacting the market value of their longer-term assets.
Well, thank you very much for that overview, and certainly looking to see how these things play out in the market. Hopefully we don't end up with a TARP-like situation, because any federal recapitalization will likely be seen on one side of the spectrum as bank bailouts, and on the other side of the spectrum as a partial nationalization of the banking system, with all the strings that come attached.
Well, hold on. Remember, if your alternative is mergers, the alternative is making your already huge banks even huger. And that also has its drawbacks. In a situation like this, there is never a perfect answer. It's a question of least bad.